Well, good afternoon, everybody, and welcome to today's webinar, which will cover updates that came out last Friday from the Small Business Administration regarding the application for forgiveness under the Paycheck Protection Program, or PPP, as we have been referring to it during these webinars. My name is John Carpenter, and I'm joined today by Chris Truitt and Deb Walker. All of us have been heavily involved in PPP since it rolled out. So what are we going to cover today? We'll talk a little bit about just where we are in the program of PPP, and we'll be covering really what was disclosed in the release from SBA last Friday with the forgiveness application. A little bit more clarity on how the calculations for forgiveness will work. What are some of the limitations? What documentation do borrowers have to retain and provide to the bank with their applications? And then we'll talk about how we at Cherry Becker can help borrowers as they work on their forgiveness application. With the release that came out from SBA on Friday, and for those of you who have not seen it, we encourage you to go to the SBA website. The application is available with the guidance. It's 11 pages of documentation. Interestingly, we noted at the end, as with all government forms, there's a requirement for the government to estimate how long it will take borrowers to complete a certain form. The estimate for this application is 180 minutes, 2.5 hours to complete the application. That's considerably longer than the application for funding at the onset of this program. But in the information that was provided from SBA, there is detail on the documentation that has to be submitted to the lender to gain forgiveness. And then there's additional documentation along with that has to be retained by the borrower. And we'll talk about what the retention period is. But there is better definition around payroll periods, eligible costs, and then Chris and Deb are going to touch on some special rules that cover business owners. So let's get into it and talk about what has changed, what's been clarified. One of the biggest things, which was generating a lot of questions as the program has rolled out, concern payroll costs, which are in most cases, well, in all cases, the biggest part of the forgiveness amount. There have been a number of questions since the beginning around, gee, when is this? When are these payroll costs? What defines incurred or paid? And is there any provision for getting payroll included, even if it might be slightly outside the forgiveness period? And so there was much better clarity released on this. No change in the fact that at least 75% of the loan forgiveness amount has to consist of payroll costs, which, as you recall, payroll costs were defined as not only wages, commissions, tips, and bonuses, but payroll costs also includes the non-payroll or the benefits, health benefits and retirement benefits and things such as that, which we'll touch on here. So that has to be at least 75% of the loan forgiveness amount, or stated in the reverse, non-payroll costs cannot exceed 25% of the forgiveness amount. And up until the release of the application and guidance, the best we knew about what was this eligible forgiveness period for calculating these payroll costs, we all were working under the assumption that, based on the guidance in the statute, that forgiveness period started on the day that the PPP loan was dispersed, and it ended 8 weeks later. What's been clarified is that, yes, indeed, 8 weeks later, and keep in mind, if you get your loan dispersed on a Monday, then your forgiveness period ends on a Sunday, which is 8 weeks later. If it ended on a Monday, that would be 8 weeks and 1 day. But it clarified that really there's two options now for at least all borrowers whose payroll cycle falls biweekly or more frequently. That forgiveness period can either start on the day the PPP loan was funded, or if your payroll cycle is biweekly or more frequently, you can choose to start the forgiveness period on the first day of the pay period after loan funding. Already, just in the last few days, as we've worked with a number of clients on forgiveness projections, we're finding that if you happen to have a payroll that was effective within a few days after your loan was funded, then it is possible that you could recover probably over 9 weeks of payroll in the 8-week forgiveness period. But these are just one of the things to look at in a projection. On the other hand, if you had payroll that funded perhaps a few days just before the PPP loan was funded, then it could be worthwhile to start the forgiveness period on the first day of the pay period after the PPP loan was funded. One other point of clarification, which had been questioned repeatedly, is will employers be encouraged to book a short period payroll just before the end of the forgiveness period in order to capture accrued wages up to the end of the forgiveness period? And what was clarified is that any wages incurred during the forgiveness period but paid on the next pay date after the end of the forgiveness period are included in the forgiveness calculation. Thus, as an example, if you have a payroll that you run, if you pay biweekly, and you have a payroll that you run on a Friday, or it's effective on a Friday, and your forgiveness period is going to end one Friday later, then you can accrue that 1 week of payroll between the last pay date and the end of the forgiveness period. And as long as it's paid 1 week after the end of the forgiveness period, that's still included in the forgiveness amount. There was clarification around, well, what constitutes the payroll effective date? And SBA clarified that the payroll effective date is either the date of distribution of paychecks or the effect date of when ACH direct deposits are originated. Now, for companies that have a mix of people getting paper checks and direct deposits, what that actually means is the effect date is really 2 different days, probably, because as anyone who runs payroll knows, ACHs have to be originated usually a day before the employee accounts. So I suppose technically it's possible that a payroll effect date, if ACHs are originated on a Thursday and paper checks are distributed on a Friday, then you really have a split effect date. For simplicity, it's probably going to be easier for most employers to count the effect date as those ACH direct deposits are originated. And a reminder, no change from what we've seen before, but as a reminder, the eligible payroll costs, the eligible wages, commissions, and bonuses are capped at $15,385. That's that magic number that is 8/52 of the $100,000 annualized limit. Now I'm going to hand it to my partner Chris to talk about some special considerations for business owners.
Thanks, John. I think that I get to talk about probably the most unpopular provision in this entire release, and that is with respect to Schedule C owners, sole proprietors. Basically, what they have said is that if you are a Schedule C person that received a loan, when going to calculate your forgiveness, you cannot include health insurance of the owners or retirement plan benefits of the owners. And you effectively will get the lesser of 850 seconds of the 2019 Schedule C income, or 15,385. And that's for people who have Schedule Cs who are not employing anyone other than just themselves. They're self-employed. If you have employees and you are filing a Schedule C, you would also get to include payroll for your employees that are contained in that Schedule C, as we would for all of the other types of businesses. The other clarification was with the respective partners receiving K-1s and reporting self-employment income. So to the extent that you use self-employment income from the 2019 K-1 in determining the amount of loan that you could take, when it comes time to do the forgiveness calculation, you will basically get 850 seconds of that 2019 SE income from the K-1, which in most cases would probably be the $15,385. The one thing I think to point out there would be some question about whether or not guaranteed payments are being made to the owners in an LLC. We would recommend that you probably make the $15,385 worth of guaranteed payments during the 8-week period to the owners, just in case there's ever any question about whether or not funds were actually paid during the 8 weeks. But we think it's going to be really driven off the 2019 self-employment income from the K-1. And then probably the most interesting part or least favorable part was for S corporation and C corporation employee shareholders, these same rules apply. So again, you don't get to pick up retirement contributions or health insurance contributions for employee owners, even in a C corp owner, and there is no threshold for how much ownership is an owner. I think if you are an owner, you're subjected to these rules. So if we can talk about payroll, what are payroll costs incurred or paid? When we look at those 8 weeks, and John's covered some of this already, there you are basically going to get more than 8 weeks worth of pay if you choose to do so. For example, if your pay period is a few days after loan funding, and that was, say, a biweekly payroll, you're effectively paying for 2 weeks of payroll that probably was for time incurred before the loan funding. And then when you have your first payroll after the 8-week period, you'll pick that up as well on an accrual basis for the period for which they're paying employment during the 8-week period. So you're going to wind up with, in that case, maybe almost as much as 10 weeks worth of payroll counting in that 8-week period, which should be helpful in getting to full loan forgiveness. I think the thing to look at there is, even though someone may not be making $100,000 a year, if suddenly we have people that are borderline making $100,000 a year and we're picking up 10 weeks worth of pay, we may have a lot more being subjected to this $15,385 cap. And that cap applies to bonuses, commissions, everything. So there's been a lot of suggestions about paying bonuses to people during the 8-week period to help aid in the forgiveness calculation. Well, that only works if those people are making less than $100,000 or $15,385 in the 8-week period. So if you're looking at strategically trying to maximize that, the bonus dollars should go to the people that are under that $15,385 cap. Things that are included would include severance pay, and the things that the big thing that would be excluded would be mandated paid leave wages can't be included in that. And the other big thing was, as John mentioned, we are on the accrual method for the back end of the payroll. So as long as you are paying for work that was done during the 8-week period, your first payroll period after the 8-week period can capture those costs for employment done during that 8-week period. With that, I will turn it over to Deb.
Thanks. Now, what I want to talk about is benefit payments. First, we're going to talk about health benefits, and then we're going to talk about retirement plan benefits. So for health benefits, we actually had very favorable rules. The unfavorable one, of course, is that it's only for employees, as Chris mentioned. And when we're doing planning, we're going to consider that it's not for workers and not for owner employees. which is how we read the instructions. We're hoping for clarification and they'll loosen the rule up. But for planning purposes, we're going to be as conservative as we can so that we maximize forgiveness, taking the most conservative position. It is the employer share of costs paid during the 8-week period. It doesn't include salary reduction amounts that the employee has paid, because that's going to be included in your gross wages that John and Chris talked about. It includes premiums for either an insured plan or a self-insured plan. It includes HRAs, FSAs, so flexible spending accounts. It includes high deductible health plans, dental, vision. It does not include HSAs or QSARAs, the qualified self-employed health reimbursement arrangements. That's because they're not group health plans. And it does, of course, include benefits that are paid in a self-insured plan, either from the employer's general assets from a special bank account. But it does have to be amounts that are paid. So if you are not going to have enough health expenses, especially as a self-insured, you might want to set up a trust to fund those health benefits. That way you can make payments into the trust within your 8-week period. Those amounts would then be used after the 8-week period. The same way you could ask your insurance company if you could prepay some of the premiums for after the 8-week period. But this is on a paid basis, so it doesn't worry about prepayments, at least in the guidance we have now. Moving to the retirement plan provisions, this was also favorable guidance, except that it only applies for employee contributions for employees. So if you have a large number of employees, that's going to be all right. But if you have very few employees and mostly partners or owners or sole proprietors, then this is going to be a limiting factor. And again, we're hoping this changes. We think it's very unfair. And so we're hoping for clarification, and in true fashion, they'll give us some rules in a few weeks and we can all reverse course. But for right now, it's the employer share of costs for retirement plans during the 8-week period. And in my opinion, that includes both 2019 contributions, if they're funded in the 8-week period, and the 2020 contributions, if funded in the 8-week period. So you could make contributions for 2 years. Now, you wouldn't deduct all of that in 2019. You would deduct a portion of it in 19 and a portion of it in 20. Because, of course, you have to be careful that you don't make contributions that are non-deductible. You also have to be careful that you follow your plan provisions, because you want the plan provisions to you want any contributions you make to conform with whatever your plan provisions are. Of course, plans can be amended, but this is all the kind of stuff we need to pay attention to as you make your payments during the 8-week periods. There's a big question we also get: can you make contributions even though you might not allocate them during the year? And the answer is yes. You can make contributions for 2020 and allocate them later in the year, assuming that's what your plan provisions allow. So with that, let me turn it back over to John for the rent and mortgage interest.
Thanks, Deb. And there weren't so many clarifications or changes here regarding rent or mortgage interest. So some of this is a bit of a recap from what you may have seen earlier. But included in the forgiveness are rent and mortgage interest, rent under leases, mortgage interest for real or personal property used in the business. These obligations have to have been in place and documented as of February 15th of 2020. And there was clarity in the application form that copies of these documents, copies of promissory notes, amortization schedules, leases, will have to be provided to the lender. Now, there was clarity that if there is past due rent or mortgage interest, that can be included in forgiveness. Borrowers cannot prepay any mortgage interest, and mortgage principal was never part of the forgiveness calculation, and it still is not. Prepaid rent to a landlord does appear that can be included in the forgiveness calculation. And we've had a lot of questions about whether related party rent or affiliate rent can be included. And from everything we can tell, the answer is yes, that is included in the forgiveness calculation. But again, there needs to be a written, signed lease obligation in place to document that. One of the other big non-payroll cost categories are utilities. Let's talk about that for a second. And again, there was not a lot of change or clarification on the utilities section. So some of this is a recap of what we've seen before. And then some of this is kind of the best views from ourselves and others we've talked to about what's included in forgiveness and what is not included in forgiveness. But again, as a bit of a recap, what's eligible for utilities are electricity service, natural gas service, water, telephone, including cell phones, internet access, transportation, which based on some other provisions not directly written for PPP, we believe covers gas used in business vehicles. Past due amounts of these utilities can be included. And it appears that prepayments, at least it's very clear that payments made for utilities during the forgiveness period, but not actually paid until the bill is due after the end of the forgiveness period, are forgivable. Similar to rent and mortgage, the evidence of these utility obligations has to be provided to the lender, presumably including perhaps one or two utility bills that reflect that the service was in place prior to February 15th will be sufficient evidence. And then I've added a few bullet points here because as we've been working through forgiveness with a lot of companies, there's been a lot of questions about, well, what else is included in utilities? And based on what we read and what we hear from others who have been studying this, we think that things like trash pickup, here are the things that we think are not part of utilities: trash pickup, recycling pickup, indoor or outdoor maintenance around your building, VPN service, even though internet access is a utility, we believe VPN service and other types of IT security services are an IT support function, and they're not really a utility. Maintenance of your email server, not really a utility. And other kinds of IT security and IT support functions are just that. They're IT security and support. They're not really a utility. And so we do not believe those would hold up as being an allowable and forgivable expense. There are still some mandatory reductions. And for that, I'm going to turn that over to talk about the mandatory reductions and some of the clarification we got there.
Thanks, John. So this is a reduction that's very important because after you add all the expenses that you think could come in through the 8-week period and could be forgiven, then you have to apply a fraction which could reduce all of those expenses. And it's important to know there's a number of different alternatives. You've probably seen these fractions before, but you have a base period, which is either February to June of 19 or January to February of 20. Or, and this is recently issued guidance, if you're a seasonal employer, and then you can have any consecutive 12-week period between May 1, 19 and September 15th, 19. Let me pause here for seasonal employers because SBA has really not been good in timely releasing guidance. So a month after the loans came out, they released guidance on how seasonal employers could count their W-2s for the maximum loan amount. And instead of using a 12-month period, you could use your busy season period and amortize and look at only 12 weeks instead of 52 weeks. That didn't do anybody any good because everyone had already applied at the time. However, they had so if you're a seasonal employer, you need to pay attention, and perhaps you'll be able to get even more by revising the way you calculated your maximum loan amount based on these seasonal rules, which is a consecutive 12-week period between 1/19 and 9/15/19. So for everybody, you choose one of these denominators, and then you compare it to the 8-week period, and we're talking about full-time equivalent employees here. So how do you make this calculation on full-time equivalent employees? First of all, as you can see, employees under these rules are paid 40 or more hours are considered one employee. So you've got to work 40 hours to be a full-time employee. If you work less than 40 hours, then we're going to look at the hours that you work in whatever period, the 8-week period, the base period in 19, January and February of 20, the seasonal time period that you choose, whatever period you're looking at, we look at it on a weekly basis. How many hours did you work? Divide it by 40, round to the nearest tenth, and then average it the period. Now, since that was so complicated, they said, okay, here's another way you can do it. You can just count anybody that's a full-time worker as 1, and anybody that's less than 40 hours a week as 0.5. So you don't have to do all those fractions that are in this green box. You don't have to divide by 40, round to the nearest tenth, and then average. You can just count a part-time worker as 0.5. And unfortunately, what that means is we have to collect a lot of data to figure out the maximum loan forgiveness based on all these different alternatives. So there are a couple other very favorable rules that are on this slide having to do with the full-time equivalent calculations. And this, I can't emphasize enough how important this is. First of all, they've said, if you make a good faith offer to somebody and they turn down your offer, you have to maintain that good faith written offer, document that it was turned down and rejected by the employee, and then you get to count those people as if they're employed by you. In addition, if somebody voluntarily resigned or was fired for cause or had reduced hours, you can count them as employed and count them at the original hours they had if it was all voluntary. The second bullet here, which is voluntary resignations, of course, you don't get to count them as an employee if you hired somebody to replace them. So to the extent they've been replaced, then you don't count them as an employee. And then there's a safe harbor, and the safe harbor is very favorable. The safe harbor says that if you reduced your full-time employee levels between February 15th and April 26th, and then you get back to where you were on February 15th by June 30th, then you don't have to have a reduction for any of these things. So if you did have reductions in February, March, or April, and you restore those levels by June 30th to where you were on February 15th, then you don't have to have a reduction. And with that, I'm going to turn it back over to Chris to talk about the salary and wage reduction calculation, which is also pretty favorable.
So the second big reduction, and this one comes kind of after the fact. After you've done all the other work, you have to go through and figure out if you have reduced someone's compensation by more than 25%. Now, this reduction only applies to people who did not earn $100,000 on an annualized basis in the prior year. So it's the less than $100,000 people that this potential reduction could apply to. So For salaried people, it's easy. You know, it's if you made $80,000 and you have a reduction of more than 25%. So if you reduce someone's comp by more than $20,000, then you're going to have a dollar for dollar reduction in your forgiveness by the amount of that reduction. For the hourly people, it's pretty straightforward as well, because you look at strictly their hourly wage. So if someone was working overtime and getting time and a half, you're not going to consider what their average hourly wage was. It'll just be their base hourly wage. So it won't include bonuses, commissions, anything like that. Any kind of variable compensation gets excluded from that calculation. So if someone was making $20 an hour, and as long as they're making $15 an hour or greater, there's nothing to consider. Now, if by chance you did actually reduce someone by more than 25%, we have the same kind of safe harbor we had on the FTEs. So if you restore their compensation by June 30th, 2020 to the levels that they had between February 15th and April 26th of 2020, then there's no reduction. So one of the things to think about on the reduction is, if you're being faced with a loan amount, if you're not going to have full forgiveness, why not restore the people's compensation during the 8-week period? If that's going to give you dollar for dollar forgiveness, it's not really costing you anything, unless for some reason you want to have a loan and use that money for the 18 months after the fact. I mean, that's another consideration, but regardless, the safe harbor is there to where as long as you get people back to restore their compensation by June 30th of 2020, then you're fine. That's fine. Let's go to the next one. So on the documentation that's going to be required, so it's going to be the lender that's going to be doing the forgiveness determination. The SBA will not get into the specific forgiveness calculations. It's going to be the lender that's going to do that. And I think, as we've talked about in the past, from an audit perspective, as long as your loan and the loans of all affiliates are less than $2 million, the SBA is not going to audit this. And when I say less than 2 million of affiliates, in aggregate, less than $2 million. So what are we going to need to give to the lender? And here's what the guidance says. So we have to obviously be able to support the payroll amount. So that can be in the form of tax forms, canceled checks, payment receipts, drafts, all those good things for payroll, the standard stuff that you would think about, payroll registers. And obviously if you're using a third-party payroll provider, ADP, Paychex, whoever the case may be, whoever it may be, they're going to have standardized reports that you can use to provide to the lender to help document this. The work is going to come in taking those numbers and making sure we're properly limiting those to the 15,385 on an employee by employee basis, but still you're going to need to reconcile back to those payroll tax reports. The FTE support will be kept with the borrower. It does not have to be provided to the lender. That's for your own records. So that's again, you have to have it and maintain it, but you're not going to be required to provide that. They're essentially going to take your word for it. Now, would lenders possibly still ask for that? It's possible, but it's not part of the application process. We can go to the next. So the other thing that we really have to think about is what if the loan, as everyone had to attest to, that they needed the loan, right? And I think the guidance has said there's a safe harbor. If your loan amount was less than $2 million, then you meet the safe harbor. You don't have to provide all the documentation potentially. If you're 2 million or more, you do have to have documentation as to the necessity for the loan. Again, that is going to be, I think, maintained at the borrower level. You're not going to have to provide that to the lender, and you're going to have to keep that for 6 years after repayment in the event that it's asked for. The other thing that you have to have is, were you determined if you were eligible due to the affiliation rules or the employee headcount rules, all those wonderful things that hoops we had to jump through to determine if you were even eligible. You have to maintain that documentation for the 6-year period. So in terms of when we ask for this, obviously you can't ask for it until after you get through the 8-week period and have had a little bit of time to assemble this data. But you have to ask for forgiveness within 6 months of the loan funding, or October 31st, 2020. And we're using that October 31st, 2020 date because that's what is referred to as the expiration date of the loan forgiveness form. So as long as you're within the 6 months for October 31st, that's when you've got to ask for forgiveness. 60 and you can do it as early as 60 days. And excuse me, as early as a week, really, after the 8 weeks are up. And the lender has to acknowledge within 60 days after you've submitted the loan forgiveness, their decision on your forgiveness application. Once you do receive loan forgiveness, to the extent you have been deferring payroll taxes under that regime, you will have to turn around and pay those back at that point in time. The last thing with respect to loan forgiveness, and this is another contentious point, in my opinion, is the CARES Act says that the loan forgiveness is not taxable. However, the IRS came out with a notice that said any expenses paid that support the loan forgiveness amount are not deductible for federal tax purposes. Well, that is effectively saying that the loan forgiveness is taxable. So I have an issue with that. Congress, apparently, certain members of Congress had an issue with that. They're pushing to have the law changed to make it definitive that those deductions are still available. But we'll see where that goes. Turn that back over to John at this point.
Yeah, and Chris, at the risk of amending one thing you said in terms of the FTE calculation, I actually was just looking at this earlier today. On the forgiveness application, it does say that borrowers have to provide support for their FTE counts in the periods prior to forgiveness. So either that optional January and February of 2020 or the 2019 periods. Now, curious to me, they're asking for support around FTE counts before forgiveness begins, but not asking for support of FTE counts during the forgiveness period. I openly wonder if that's going to change before this is all over.
Well, I think we're going to see more. Unfortunately, they've had a nice pattern of, as soon as they come out with one set of guidance, they seem to come out and contradict themselves a week later or clarify when all the questions start coming. So I'm sure we'll see some additional guidance on that.
Yeah, I totally agree. So there's one thing I want to highlight on the timing of your loan forgiveness. You know, there's a provision where you can defer the employer's share of Social Security up to $137,000. That's 6.2% that the employer pays for up to $137,700. That ends with forgiveness approval. So some people are considering delaying their forgiveness request in order to continue deferral of these taxes. So there is a little bit of timing that can help there. Absolutely. So what are borrowers to do in terms of preparation? We've certainly been talking to a lot of companies who already have their PPP money, may have just gotten it, or may have gotten notice that it's about to come. And you've heard us say on previous webinars, planning is paramount. In terms of applying and getting the PPP money up front, speed was what it's all about. In forgiveness, we think planning is what it's all about, because without doing that, there could be some real unpleasant surprises at the end. So other than planning around how to spend the PPP money, everyone can really start tracking the payments that are made during the forgiveness period. Start saving those evidence of payments. Literally, if you look at the application, this is reinforced. You will need copies of canceled checks, screenshots of ACH transactions, statements from landlords, utility bills, amortization schedules, and
and confirmations of payment on mortgage interest, copies of lease agreements, mortgage documents, evidence of utilities prior to February 15th, all these kind of things. So putting together an electronic file of these documents and screenshots is going to be easier to do as you go, probably, than at the end. And then, as Deb has mentioned, this potential reduction for FTE calculations, we are finding that much more so than the potential reduction around salaries and wages, this potential reduction for FTE counts is just much more problematic. It's harder to track. It's harder to figure out what the reference point is, as Deb pointed out earlier. What is that right denominator, and then plan for how you get through the forgiveness period without having a big surprise at the end and find, I've got a large part of my forgiveness that is not going to be forgiven. And if it's not forgiven, it's just part of the loan, which then has to be repaid over 2 years. So we have been involved in just countless discussions with borrowers about how to plan for this FTE mandatory reduction. And how can we help companies? This is, again, you saw this if you attended our earlier webinar on forgiveness, but we are now, very much up and running, helping an awful lot of companies with forgiveness planning. And we've kind of designed packages where if you just want some consulting assistance for Q&A, that's fine. But we have a lot of companies that have signed up to help us plan a forecast of how to spend their money in the forgiveness period, do a check-in along the way, and then help develop that checklist, get all the items together, and actually calculate the forgiveness at the end. And you can see here, you've got a link to how to start the process, and we've set up fixed price packages based on loan size, and we have a team that is busy working, helping a lot of companies with this forgiveness consulting and assistance. So if we can help you, we look forward to hearing from you. That's really all we had today. We will continue to roll out webinars and articles as new guidance comes out. These slides will be made available and published on the site. If not by the end of today, we'll certainly get them up there by tomorrow morning. This webinar has been recorded, and we will post the recording in case you want to go back and refresh yourself on anything that we covered. We very much appreciate everybody's interest and hope you have a good rest of the day.